In January of 2026, the IRS quietly updated 4 rules that directly affect every American retiree who has money sitting in a 401k, and the combined effect of those 4 changes could cost you anywhere from $1,800 to over $9,000 this year alone, depending on how much you have saved and when you started taking withdrawals. If you are between 55 and 75 years old and you have a 401k or a traditional IRA or both, then what happened in January was not a minor administrative adjustment. It was a structural shift in how the government expects you to move your own money out of your own retirement account and how much of it they plan to take when you do. None of this was announced in a press conference. None of it showed up in the letter the IRS sends to most seniors. It was published in IRS Notice 2026-03 and in updated guidance under Treasury Decision 9998. And unless you read the Federal Register the week of January 13th, you would have had no reason to know it happened at all. By the end of what I'm about to walk you through, you will know exactly what all 4 rule changes are. You will know the one IRS form that now determines whether you overpay or underpay on your required withdrawals. And you will know the single deadline in April of this year that most retirees do not even know exists. My name is David Chen. I spent 27 years as a senior field agent with the Internal Revenue Service. I retired in 2022. I am not a tax preparer. I am not a financial advisor. I am the person who used to enforce the rules I am about to explain to you, and I can tell you from direct experience that these rules were not designed to be understood by the people they affect most. Let me walk you through what changed, and I will take them one at a time. The first rule change involves required minimum distributions. You may already know that once you reach a certain age, the IRS forces you to start pulling money out of your 401k or traditional IRA whether you need the money or not. Under the Secure 2.0 Act, that age was pushed to 73 and it is scheduled to move to 75 in 2033. That part has not changed. What changed in January 2026 is the way the IRS calculates the life expectancy factor used to determine how much you are required to withdraw. The IRS updated the Uniform Lifetime Table, which is published in IRS Publication 590-B. The new table revised the divisor numbers downward for people between the ages of 73 and 78. That sounds like a technical detail. It is not. A smaller divisor means a larger required minimum distribution. A larger required minimum distribution means more taxable income. More taxable income means a higher tax bill. And for many of you, it means your Medicare Part B premium goes up too, because Medicare uses your modified adjusted gross income from 2 years prior to set your premium through the income-related monthly adjustment amount known as IRMAA. So a change in how the IRS calculates your RMD in 2026 could increase your Medicare premium in 2028. That chain reaction is not explained anywhere in the IRS notice. You have to connect it yourself across 3 different federal agencies. The second rule change involves Roth 401k accounts. Before 2024, if you had a Roth 401k through your employer, you were still subject to required minimum distributions even though Roth IRAs were exempt. The Secure 2.0 Act eliminated RMDs for Roth 401k accounts starting in 2024. That was the law. But in practice, many plan administrators continue to calculate and issue RMD notices for Roth 401k participants through 2025 because the IRS had not yet issued final regulations clarifying the operational details. In January 2026, the IRS published final regulations confirming that no RMD is required from a designated Roth account in an employer plan for 2024 or any year after. If your plan administrator sent you an RMD notice for your Roth 401k in 2024 or 2025, and you took a distribution you did not need to take, you may have created an unnecessary taxable event. You did not owe that withdrawal. The IRS rule said so. Your plan administrator just had not caught up. There is no automatic correction for this. You would need to work with your plan administrator and potentially file an amended return depending on how the distribution was reported. The IRS will not contact you about this. They will not fix it for you. You have to know it happened, and you have to act. The third rule change addresses the 10-year rule for inherited retirement accounts. If you inherited a 401k or a traditional IRA from someone who passed away in 2020 or later, and that person had already begun taking required minimum distributions before they died, then you are subject to what the IRS calls the 10-year rule. Under the original Secure Act, the entire inherited account must be emptied by the end of the 10th year following the year of death. But the IRS spent years going back and forth on whether beneficiaries also had to take annual distributions during that 10-year window. They proposed regulations in 2022. They waived penalties in 2023 and 2024. In January 2026, the IRS finalized the rule. If the original account owner had already started RMDs before death, then you, the beneficiary, must take annual required minimum distributions in each of the first 9 years and withdraw whatever remains by the end of year 10. This is no longer proposed. It is final. The penalty for failing to take an annual distribution from an inherited account is 25% of the amount you should have withdrawn. If you correct it within 2 years, the penalty drops to 10%. But you have to know the rule exists to correct it. And most people who inherited a retirement account from a parent or spouse in the last 5 years have never been told this. The plan custodian is not required to notify you. The IRS does not send a reminder. It is your responsibility, and the penalty is automatic. The fourth change is narrower, but it affects a specific group of retirees who are still working part-time. If you are over 73 and still employed and you have a 401k with your current employer and you do not own more than 5% of the company, you can delay your RMD from that specific employer's plan until April 1st of the year after you actually retire. That is called the still working exception. In January 2026, the IRS clarified through updated guidance in Notice 2026-03 that this exception does not apply to 401k accounts from previous employers, and it does not apply to traditional IRAs regardless of your employment status. This has always been the technical rule, but the IRS had never drawn a bright line in public guidance this clearly before. The result is that some retirees who rolled old 401k balances into their current employer's plan, thinking they were covered by the still working exception, have now been told explicitly that only contributions and earnings within the current employer plan qualify. If you consolidated old retirement accounts into your current employer's 401k and you have been delaying RMDs on the entire balance, you may owe a corrective distribution and possibly a penalty. The window to self-correct under the IRS Voluntary Correction Program is open, but it requires you to file the appropriate paperwork before the IRS identifies the shortfall on their end. Now let me tell you what this looks like for real people. Frank is 74 years old. He lives in Ohio. He retired in 2023 from a manufacturing company where he had worked for 31 years. He has a 401k balance of about $182,000. Under the old Uniform Lifetime Table, his RMD for 2026 would have been approximately $7,600. Under the revised table, his RMD is now approximately $8,100. That is $500 more in taxable income. Frank is on Social Security receiving about $2,140 a month. That additional $500 in RMD income pushes his combined income just above the threshold, where 50% of his Social Security becomes taxable instead of 0%. The threshold for a single filer is $25,000 in combined income. Frank was right at the edge. The revised RMD table pushed him over. He did not spend the money. He does not need the money, but the IRS says he has to take it, and now a portion of his Social Security check is taxable too. Frank will owe roughly $1,100 more in federal tax this year than he did last year, and nothing about his life changed. Only the table changed. Linda is 68 years old. She lives in North Carolina. Her mother passed away in 2021 at age 79. Her mother had a traditional IRA worth about $95,000, and had already been taking required minimum distributions. Linda inherited the account. She was told by the custodian that she had 10 years to empty it. She was not told she needed to take annual distributions during that 10-year window. She took nothing in 2020, 220, 23, 2024, or 2025. Under the finalized rule, she should have been taking annual RMDs every year. She now has 4 years of missed distributions. The penalty at 25% would be over $7,000. If she self-corrects within the allowed window and files Form 5329 with a reasonable cause, explanation, the penalty drops to 10%, which is still roughly $2,800. Linda is a retired school cafeteria worker. Her total monthly income is $1,460. $2,800 is nearly 2 months of income. She did not know the rule. No one told her the rule. The IRS finalized the rule in January, and it applies retroactively to every year since her mother died. Tom and Barbara are 71 and 73. They live in Arizona. Tom is still working part-time as a consultant for a construction company. He has a 401k with that company worth about $60,000. He also rolled over a 401k from a previous employer's worth about $120,000 into his current employer's plan 3 years ago, thinking it would simplify things. He assumed the still working exception covered the full balance. Under the January 2026 guidance, it does not. The $120,000 that came from the old employer plan is not eligible for the still working exception. Barbara's RMD from her own traditional IRA also increased under the revised life expectancy table. Together, they are looking at roughly $4,000 in additional required distributions they did not plan for. And the tax impact pushes Barbara into a higher IRMAA bracket for Medicare starting in 2028. Their Part B premium could rise from $185 a month to $259 a month. That is an additional $88.80 per month in Medicare premiums for a rule, change they never heard about. Let me ask you a direct question. Do you know what your required minimum distribution is for 2026 under the revised Uniform Lifetime Table, published in IRS Publication 590-B, and have you verified that number against what your plan custodian is telling you? If you have not done that, you do not actually know whether you are in compliance. Here is what they buried and where they buried it. The revised life expectancy tables are in IRS Publication 590-B, which was updated in January 2026. You can find it on the IRS website, but it is not on the front page. You have to search for it by publication number. The table you need is called the Uniform Lifetime Table, and it is in Appendix B of that publication. If you are the beneficiary of an inherited IRA, the table you need is the Single Life Expectancy Table, also in Appendix B. These tables are the only way to calculate your correct RMD. Your plan custodian may or may not use the updated tables. Some custodians are still calculating based on the 2022 tables. You need to verify the number yourself. The finalized rule on inherited IRAs and the 10-year annual distribution requirement is in Treasury Decision 9998, published in the Federal Register in January 2026. The relevant section is 1.4.019-1. That is not a section of the tax code most people have ever seen. It is not referenced in the standard Form 1040 instructions. It is not mentioned in any of the letters the IRS sends to beneficiaries of inherited accounts. If you want to verify it, you can search for TD 9998 on the Federal Register website. The still working exception clarification is in IRS Notice 2026-03. The notice specifies that only amounts attributable to the current employer plan qualify for the exception. Rolled over balances from prior employer plans are treated as if they are still subject to the standard RMD rules. This notice is not available through the IRS automated phone system. It is not referenced in the standard 401k disclosure documents most employers provide. It exists in the IRS Notice Archive, and you can access it by searching Notice 2026-03 on the IRS website. The MAA brackets for Medicare. Part B are published by the Centers for Medicare and Medicaid Services, and for 2026, the first threshold for a single filer is $106,000 in modified adjusted gross income. If your income crosses that line by even $1, your monthly Part B premium jumps from $185 to $259. The income the government uses is from your tax return 2 years prior, so your 2026 income determines your 2028 premium. The connection between an RMD increase and a Medicare premium increase is real, and it is documented, but it is never explained in one place. You have to read IRS, Publication 590-B, then cross-reference CMS, Medicare guidelines, then look at your own 1040 from 2 years ago. No single government offices will walk you through this chain. The form that matters most to you right now is IRS Form 5329. This is the form you use to request a waiver or reduction of the penalty for a missed or insufficient required minimum distribution. If you are someone who inherited a retirement account and did not take the annual distributions now required under the finalized 10-year rule, you need to file this form. The reasonable cause standard is not clearly defined, but the IRS has historically accepted explanations that show the taxpayer relied on incorrect guidance from a plan custodian or was not informed of the requirement. You must attach a letter explaining what happened and what you have done to correct it. File this form with your 2025 tax return if you missed distributions in prior years. If you have already filed your 2025 return, you can submit an amended return with the form attached. Now here is what I want you to do, and I am going to be specific because general advice is worthless. First, pull up IRS publication 590-B on the IRS website and look at the Uniform Lifetime Table in Appendix B. Find your age. Find the divisor next to your age. Divide your retirement account balance as of December 31st, 2025 by that divisor. That is your required minimum distribution for 2026. Compare it to whatever number your plan custodian gave you. If the numbers do not match, call your custodian and ask them which table they used. Second, if you inherited a retirement account from someone who died in 2020 or later, and that person was already taking RMDs, you need to determine whether you have been taking annual distributions. If you have not, you need to calculate what you should have taken for each missed year using the single life expectancy table in the same publication. Then take the missed distributions as soon as possible and file Form 5329 requesting a penalty reduction. Third, if you are still working and you have rolled over old 401k balances into your current employer plan, call your plan administrator and ask whether your RMD calculation separates rollover balances from current employer contributions. If it does not, you may be under withdrawing, and you need to correct that before the end of this tax year. Fourth, look at your 2024 tax return. Find your modified adjusted gross income online, 11 of Form 1040. If that number is anywhere near $106,000, understand that your 2026 RMD could push your 2026 income above the IRMAA threshold, and your 2028 Medicare Part B premium will increase. If you have room to do a Roth conversion of a portion of your traditional balance this year, you may be able to manage your income more strategically in future years. But that is a decision you should make with a tax professional who understands the IRMAA brackets. There is one more deadline you need to know about. If you turn 73 in 2025, your first RMD is due by April 1st, 2026. That is not December 31st. That is April 1st. And if you delay your first RMD to April 1st of 2026, you will also owe your 2026 RMD by December 31st of 2026. That means 2 RMDs in one calendar year, which could double your taxable income for that year and push you into a higher tax bracket and a higher IRMAA bracket simultaneously. The IRS does not warn you about this. Your plan custodian may send you a letter, but by the time you get it, the damage is already calculated. I spent 27 years inside the system that created these rules. I watch the language get more complicated with every revision. I watch the publication page counts grow, while the plain language explanations shrank. I watch the call centers get understaffed and the hold time stretch to 2 hours and then 3 hours. And now, with the staffing reductions at the IRS in 2025 and 2026, many local taxpayer assistance centers have reduced their hours or closed entirely. The system is not broken by accident. It is functioning exactly as designed. The complexity is the feature, the confusion is the product, and the people who pay the price are the people who can least afford to pay it. Everything I have told you today is verifiable. Every publication number is real. Every form number is real. Every deadline is current as of March 2026. I'm not asking you to trust me. I'm asking you to look it up yourself, and when you see that it is all exactly where I said it would be buried in appendices and Federal Register notices and sub-regulatory guidance that no one ever expected you to read, I want you to understand that you were never supposed to find it. But now you have. What you do with it is up to you. Do not wait for someone to send you a letter. Do not assume your plan custodian has it right. Pull the publication. Run the numbers. File the forms. The deadline that matters most is April 1st, 2026, and it is less than 30 days away. If that deadline applies to you, do not wait until tomorrow. You have the information now. Use it.